We are starting to see some significant red right across the market for what feels like we haven't seen in quite a while, and today we are focusing on Eli Lilly that reported before the market open, and right now they are currently around 6 to 8% down. It does fluctuate quite a lot, and we want to understand why is this company down, and is it an opportunity to consider a high quality company in the pharma industry in our portfolio. Now, as we can see, they did miss their estimates. On top of that, they've slashed their profit guidance, which is never a good sign, and we're going to understand exactly how far off these numbers are from what the analysts were anticipating. So first thing to note, EPS 118, that is quite a substantial miss from the 147 the market were hoping for, and we can see the revenue did come in fact around 500 million under what market wanted at 12.11 billion. Now, on top of that, with Eli Lilly, the market do like to look at a few of their products, and one of them, they had their third full quarter on the US market, bringing in 1.26 billion, which was again a massive way off the 1.76 investors were anticipating, and again for another income stream, 3.11 billion, which was reported, and we in fact know that is quite some way away, the 3.77 billion for the diabetes treatment. So not good, misses all across the board, and in particular to some of the income streams, some of the products that the market do like to take a look at, and we can in fact see they've lowered by quite some distance their full year EPS, and they're expecting around 13 to 13.50 in terms of each share, and that is around $3 lower. That is quite a significant percentage drop from the previous guidance. And we also note they have lowered the higher end of their revenue outlook. They're expecting around 45.4 to 46. As we can see, the guidance prior to that was a little bit higher at 46.6. So nothing really positive to take away from their earnings. Misses to EPS, misses to their revenue, lowering EPS full year guidance, lowering the upper end of their revenue target. Now, we do have to bear in mind this company has been on a mammoth run over the last year, up 48%, and over the last 10 years, more than 1,154%, significantly outperforming the S&P. When we take a look at it in respect of the 52-week range, it is still trading at the upper end. It is, although, a little bit away now from that 52-week high of $973. We get both Seeking Alpha and Wall Street giving this a buy, with Quant giving this a hold. It does pay a yield, although fairly trivial, 0.58%, and the forward P, we will come to discuss, currently sits at 67.2. Now, in terms of their earnings, what we do in fact notice, they've just missed their recent one. Therefore, when we look back to the last 4 quarters, we will therefore be able to say a 75% track record, with the more recent quarter coming in under the analyst expectations, what we've just gathered. But we do notice over the next 3 quarters, they are still expecting massive growth. Whether or not your confidence has been taken a step back given this miss, something to consider. But over the next full annual EPS, December 2025, the forward P is expected to come down to a lot more reasonable 39.08. But then again, a lot of people will still say that is very high. Question is, do you think the growth it has deserves that? Something we can come to look at. Now, they also released an investor presentation slide today, so a few things we want to highlight. First one, when we look at the year-on-year comparison to the same quarter in 2023, top line revenue is up 20%, great to note. In terms of margin efficiency, well, it is up, although minute at 0.5 percentage points. Nice to see though, massive growth in terms of the operating side, 9.2 percentage points. So looking good, revenue up double digits, and the margin, more specifically the operating side, showing us that efficiency. And when we look at their capital allocation, something I always recommend you do with every company you invest in, the bulk of what they spend is in R&D, 6.7 billion, their research and development, and we do also have a fair amount in terms of the dividend at 3.5, with a small amount here at the share repurchases at 400 million. Then if you want to see the year-to-date figure, well, their revenue is up even stronger, 27%. We get more of a gross margin efficiency, up 2.3 percentage points, and their margin on the operating side sitting at 8.2. Now, if we look at this company in terms of the actual metrics, we first want to point out the dividend safety looks to be very safe at a 96. We'll come across these two models, but what we always like with this company, it has increased their dividend at a very rapid rate, 15% last December. We are anticipating this December something very similar. And ultimately, 96, very safe dividend score, showing us the dividend cut is highly unlikely. Now, key metrics from the latest recession, 07-09 crash, they increased the dividend, they had plus 4% recession sales, S&P was around negative 12, and they marginally outperformed negative 49, as we can see, S&P negative 55. Dividend growth over the last year and the last 5 years, very strong, up double digits, although if you zoom out over the last 20 years, it does come down to around 6%. Nonetheless, they have been increasing those dividends for the last 9 years, whilst paying a dividend without a reduction for the last 33. Now, when we take a look at the valuation based on the average PE, what we notice, probably no surprise to the majority of you, but this company has, and we will show our own valuation model, been trading at quite a significant overvaluation for the whole year, and this effectively shows us the blue tunnel, the expected fair value. Eli Lilly, though, doesn't conform to those rules, been trading well above that significantly even after this drop. Now, we also have a few other models on this channel. Dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year average. This, therefore, is a massive overvaluation signal, and the same to be said on the forward P, currently at 47.3, the 5-year rolling at 34.4, again reinforcing the overvaluation. And when we look at the sector P for healthcare, it does sit much lower at 16.3, but remember, you could argue Eli Lilly does deserve its premium. Question is how much of a premium, and as always, we don't look at any one of these models in isolation. We will conclude towards the end. Now, as always, focusing on the free cash flow element as opposed to the earnings, which is susceptible to manipulation by management through accounting. Below 60%, it is very inconsistent over the last few years. We get a negative in 2023 as they were free cash flow negative, we'll come to show you. But over the next 12 months, this is expected to be positive at 45%, so hopefully we get a nice double-digit increase to the dividend this December. Now, free cash flow, always you want to see increasing and consistent, is pretty much nearly doubled over the last 9 years to 2022. We noticed, though, in the more recent year it was negative, but a massive growth expected over the next 12 months to 1150. Then we look at the sales growth, where we get to see maybe a little bit less than what we were expecting for this type of company trading at these valuations. Only over the last few years do we see double-digit increases to the top line, although notably on a trailing 12-month, we are seeing 32%, so we do expect this year to be very strong. And when we zoom out, their top line has gone from around 20 billion to 34 in 2023. Now, shares outstanding, they have essentially returned excess cash through those share buybacks. We just took a look now at their capital allocation, where it did in fact tell us that they are buying back shares around 400 million year to date, but not something that is of big importance to them. And as we can see, very inconsistent. In fact, over the last few years, it has moved very minimally. Then we get to the ROIC, one of our favorite metrics, 10% or more. Give us faith, management are able to effectively allocate their capital. And what we do in fact note, looking very strong, increasing as well over the last 10 years, around the low 30s, high 20s year on year, 33% on a trailing 12-month basis. We love to see this operating margin not just above the minimum 12%, but operating efficiency, 17% in 2014, 36% on a trailing 12-month basis, and the free cash flow margin, bar 2023, and we are expecting 2024 to be positive, has been very strong on a consistent basis. Then we get the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want, below 3 is what we get, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. And remember, correlates to both dividend safety and balance sheet strength. 2.74, pretty much the highest it's been over the last 10 years, but nice to see on a trailing 12 month and over the next 12 months, expected to come down rapidly, something we will look at now when we get to the balance sheet. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox. We look at undervalued stocks that we believe deserve your utmost attention, as well as running through what's happened in the market over the last few days. So you can click on the pinned comment below, sign up and read these straight away, where you'll also be able to gain access to 36 undervalued stocks for the month of October. A lot of information, as well as the upside that Wall Street see over the next year, and flagging those that sit within our own portfolio for those that are interested. And for just this month, you can grab 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P. So again, click below, sign up, and you can read straight away. We noticed insider ownership around 0.13%, 1.2 billion of sales just over the last 12 months. But when we look at the more recent quarter, no movement. Q3, 393 million worth of sales. Q2, 674 million. And for transparency, now we can see these insider selling, but again, they are outdated. They are in July, but information is here if you want to take a look. Then we move on to the institutional aspect. 83% ownership, 21 billion worth of sales over the last year, more than double the amount of buys during the same time period. And what we can in fact see in Q3, the more recent data point, and in fact over the last 4 quarters, institutions have been buying more shares of Eli Lilly than they have been selling, so very bullish on this company. Again, always do your own due diligence, never copy what institutions or these insiders do. Now, in terms of their top line revenue, we already took a look at this. They haven't doubled the top line, but it has increased over the last 10 years, maybe at a slower rate than what we would like to see. When we look at the bottom line, this is why we are taking a look, not something we've covered yet. We also notice a lot of inconsistency, not something we'd expect for a company trading at a very high valuation, although we do note it has more than doubled, 2.4 billion in 2014, 5.2 in 2023, and on the trading 12-month, showing us expectation is massive growth into 2024. Then we move on to the balance sheet, the quick health check, as we already said earlier. And when we start off with the cash, we do notice, whilst it has been inconsistent, has decreased over the last 10 years, around 5 billion in 2014, 3.4 billion in the latest quarter. As always though, one number doesn't tell us anything in pure isolation, so we compare it to their total debt numerically and directionally, and that has been increasing over the period. Not a great sign, with cash decreasing, debt increasing, and that is why we got that high net debt to EBITDA, 8.2 billion in 2014, 29 billion in the latest quarter. So just some things to consider, and we can impact that in our margin of safety shortly. Valuation, no surprises, an F on a forward PE, 67 with the market around 21. If you're buying this company, pressing the buy button in the market right now, you are paying a 222% premium to the overall sector. Whether you believe it or not, that is something just to consider, and no matter what valuation metric you use, you would get a very similar result that this company does trade at a very, very high premium. Now, growth does look to be a lot better, so you could argue it deserves that premium. A+, revenue year on year, 32%, overall sector at 7%, forward looking, 27%, overall sector at 8.3%, and when we do look at the next 3 to 5 years, EPS is anticipated to grow at 42%, much better than the overall sector at 10.9%. Then we get to the profitability with an A+, gross margin at 81%, much better than the sector at 58%. Bottom line as well, significantly better, in fact positive 19% with the sector median at -4%, and cash from operations looking very, very nice, 4.51 billion with the sector at -14 million. Now, quick recap for this part of the analysis: double buy rating, seeking alpha Wall Street, hold from quant, F valuation, A+ growth, A+ profitability. Now, before we jump into our own valuation model, let's see how they compared against other pharmaceutical companies roughly a similar size. Now, over the last year, total return, including dividends reinvested, Eli Lilly, the best performing, up 49%, much better in fact than the one that comes at second place, is a very strong leader. Over the last 5 years, again, massive outperformance, up 690%. Over the last 10 years, again, the best in class, 1,418. Question is, can they continue to do that, and is it worth the premium right now, even after the drop, to be fair? Then we move on to the S&P, just to show you that not only has outperformed its competitors, but also the S&P by quite some distance over the last 10 years. Can they continue to do so? Well, you probably have some confidence if you are considering adding this into your portfolio. Now let's jump into our valuation model. As always, if you do enjoy the content is provided and you are enjoying the episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of 615 effectively coming from the DCF model, and we have the free cash flow year on year, very skewed given the massive drop we saw just this year, so the average is -1. Now, moving forwards, we have gone 30%. You can see a low, medium, high, 25, 30, 35, and we have used 2024 as the previous year, given the massive drop it just saw. Now, in terms of using that with discount rate, we get the present value of future free cash flows and terminal value. We add with the cash, subtract total debt, get the equity value, divide by the shares outstanding. And in fact, what we are noticing is negative 26% downside implied with a 30%. Now, as always, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for Eli Lilly or any others. But for full transparency, we'll show you at the 25% rate, it would be an intrinsic value 453, downside of 46%, 35% as we can see, pretty much around the current trading price, so you could argue fair value. Therefore, if you're buying this company now, you're expecting 35% at a bare minimum, just to essentially hold that point true. As we said though, let's take the median rate of 30%, and therefore pretty obvious, while we do like a margin of safety, we believe Eli Lilly, even after the drop today, is still trading at a premium above a margin of safety. So what we do on this channel, typically 10% MOS, execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. And if you believe that in today's episode, we would say a buy at 553. For those that believe a smaller MOS, well at 584. And for those that believe the opposite, at 15%, 523, 20% around 492. As we said though, no margin of safety, although Wall Street, they are bullish. They have upside target 27%, their price in fact $1,064. As always, give us your thoughts. Maybe this is one that surprised you. Maybe in fact this is one that you believe should be a lot higher. Interested to hear whether it's a buy, hold or sell. If you enjoyed the episode, as we said, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.